All right, let's get to David Kudla now, a founder and CEO and CIO and Chief Investment Strategist, I should say, at Mainstay Capital Management. He joins us now. Hey, David, are you buying into this record rally here?
We're buying into this record rally. I know that there are many who are still concerned about a recession, that are worried that the price of stocks at these levels, we're at new highs. But look, what we've seen here now with this cut yesterday and what we have going forward, if there's such a thing as a Goldilocks scenario, we're about as close as we can be to it. So, I've had the expression for the last 2 years, the recession that's always 6 months away. The recession is always 6 months away. GDP right now, Atlanta GDP now for the third quarter is at 2.9%. We had 3% growth in the second quarter. We're still looking for that soft landing that the Fed rarely pulls off. So more of a mid-cycle slowdown, and then we slowly reaccelerate, and we don't get that recession. And if that's the case, 12 months later, after a first rate cut, stocks are higher and significantly higher. If you get a recession after a first rate cut, stocks are lower. So that's what we're pivoting on, but we're still optimistic and constructive on stocks at this point.
So, David, I think when I listen to some folks that are still constructive on the market, they just I think they hang their hat on a couple of things, which is one, I've got a Fed that's cutting rates, and I've got a pretty decent earnings environment that's pretty good. But one of the things that we just don't know, it's an election year, and I don't know what that means for the markets. How do you guys talk about that to your clients?
I'm glad you brought that up. We get preoccupied with politics as it relates to our investment strategy. And when I say that, I mean at average investors out there. There are investors that believe if so-and-so gets elected, it's doomsday. If so-and-so gets elected, it's nirvana. What we find out is, and this is why we'll have volatility over the next couple of months until the election, is the markets hate uncertainty. So it's about getting that uncertainty out of the way, but then it's not as much about whether it's Democrat or Republican. As far as where we invest, as tactical asset allocators, we want to look at the difference in policies. There's differences in policies in energy and a lot of areas between these two candidates, and depending on how the House and Senate go in terms of taxes and everything. So that matters as far as tactically how we invest. But the people that go to cash because they're scared, concerned, wait and see, end up typically in election years, suffering an opportunity cost. And that's exactly what's happened this year so far for people that have stepped to the sidelines.
Is there a risk, if I pivot back to the Fed for a second, so put elections on the side, is there a risk that we're going to see kind of more growth and demand resurface in a particular way because we're in that rate cutting cycle, because we got that jumbo rate hike? And is that a risk eventually for resurgence in inflation?
It is a risk, but what we've seen so far is inflation is on this glide path to the Fed's target. If anything, I think with the disinflationary forces, it'll come back into effect as we get by all the effects of the pandemic. We may overshoot the 2%, but we're certainly on a glide path to 2%. And right now, where we are with the labor market, we had some good news today. There's still some concern out there about credit card debt, credit card interest rate, auto loan delinquencies, things like that. But we balance that all out, and we think the inflation problem is gone. It's now about labor, unemployment. We get to the point where that needs to be. Rates come down to, if it's the long-term neutral rate of 3% here through 2025 for the Fed funds rate, we're in a good environment for stocks still. We know they're expensive, but stocks can be, we know, overvalued or undervalued for a very, very long time.
All right, David, so what sectors are screening well for you these days? Again, we've had an S&P 500 index move about 20% year to date, but I know not everybody's participated. So how are you guys approaching maybe like sector selection?
Right. So, one area for sure that's been troubled for quite a while especially a while back here with some of a few of the bank failures. But banks, financial services look very good. As the yield curve continues to steepen, NIM improves, net interest margin for the banks. We're finally getting that yield curve steepening. So we like the financials a lot. We still like technology a lot, the AI story. But what we're able to do now, we can broaden into value. We can broaden into cyclicals. We can broaden into small caps and diversify our portfolios from the Magnificent Seven to these other areas. Small cap companies are far more reliant on debt. And with interest rates coming down, their cost of capital coming down, maybe coming down a lot over the next year, that's good for small caps. And that's what we've been seeing recently in IWM or the Russell 2000 index.
Mid caps, sweet spot, you like them?
Mid caps as well. Mid caps, the same thing. Small and mid caps just become more attractive. And mid caps are kind of that sweet spot in between. It's been a large cap dominated stock market for quite a while. We've had a lot of head fakes with small cap and mid cap, but we think they now have a runway with rates coming down.
All right, David, thank you so much for joining us. Always appreciate getting a few minutes of your time. David Kudla, he's the founder, he's the CEO, and he's the chief investment strategist at Mainstay Capital Management. I call him the boss there, I guess, basically.